panel at the top right of your screen. If you don't see the panel, there should be a little orange arrow that you can hit to expand it. And towards the bottom of that panel then is where you can type a message in if you want to ask a question. I am actually going to hold questions until the end because there's a lot of material here and I'm not sure how much time we'll have. If we don't have time to answer all the questions, we will prepare a written question and answer document and email it out to everybody. So I appreciate that. We will also email tomorrow links to both the recording of the presentation and the slides. And finally, if you need CPE credit, you must complete the survey that will be emailed out to you as well. You should be getting an email from GoToMeeting shortly after the presentation. I would appreciate, even if you don't need CPE credit, if you would fill that survey out because I'm always interested in feedback and how I can improve. But if you do need CPE credit, you must fill it out. There are 3 code words that will be given to you throughout the presentation that also need to be typed into that survey. I think that's one of those things of making sure that you really did stay for the whole thing. But anyway, I will highlight those when we get to them, and you might want to jot them down so you remember them for the survey. So the other thing is you will also get an email tomorrow about HRCI credits. This presentation has been approved for that. So if you're someone who needs HRCI credits, you will get an email about that as well. So without further ado, we're going to launch right into the exciting world of retirement plan compliance. Okay, a little bit of an agenda. These are the things we're going to basically cover. Obviously, there are lots of topics on compliance with retirement plans, but we're going to, in general, cover things having to do with your plan documents, eligibility and compensation, a real big one with the government for the last several years, timely contributions, compliance testing, and then reporting and disclosure, and particularly Form 5500. So there are, just so you know, again, there's a lot of material in here. I'm not going to cover every last detail of the slides, but we did do separate, or are going to be doing separate webinars on just 5500 and just compliance testing. Those are available on our website if they've already occurred and you missed them, but you can at least get more detail by going on the website and viewing those presentations as well. So let's get started with plan documents. Oops, wrong way. The big deal about plan documents is you must operate the plan according to the terms of the documents, and that's one of the things people miss all the time in terms of not understanding what all the provisions are in your plan document. So take the time to review your plan document. If you have questions, ask your TPA, your record keeper, whoever's doing your plan documents for you, and make sure that you know what the terms of your plan are. Documents are required to be updated periodically, and that's not our requirement to, as a revenue generator. That's a requirement of the IRS. They occasionally will issue interim amendments that have to be adopted, but every 6 years now, they require every last retirement plan to be fully restated, redrafted, basically, to accommodate all the legislative changes in the past 6 years. And we're just starting another one of those lovely periods right now. It started April 1st of 2014, and we have until April 30th of 2016 to fully restate your documents for compliance with the Pension Protection Act. So these will be referred to by the people in my industry as PPA documents. You may not have heard from your TPA or your record keeper, your document preparer yet, because it's relatively in the new stages, but you should be shortly and realize that that's coming. There are certain types of documents, and probably most of you have these, that are pre-approved by the IRS. So in other words, the document vendor, the TPA, whoever, has submitted their whole basic document to the IRS for approval. And then you're just adopting that vendor's document. Those pre-approved documents are going to be prototype documents. There's also one called a volume submitter that are pre-approved now as well. The IRS does not want those submitted for individual determination letters anymore. So once you adopt one of those, you don't have to incur the extra expense and complication of applying for a determination letter. But it also means you won't have a determination letter anymore on your plan that has your specific company name or plan name on it. There are some kinds of documents, individually designed documents, that still have to be submitted, but 90% of plan documents don't have to anymore. One special note for safe harbor plans. If your plan is one that has a safe harbor contribution feature, and that would be a 401k plan, this is one of the, pardon my editorializing, but this is one of the dumbest rules I've seen in my 35 years in this business. Once you've issued the notice, and you have to issue your safe harbor notice at least 30 days before the beginning of the year, you can't amend anything in your plan, even if it doesn't affect the safe harbor notice, until the beginning of the next year. 2 exceptions noted there: adding Roth contributions, adding hardship withdrawals. I've had a few clients lately that have asked for things like adding a age 59.5 in-service withdrawal or changing their eligibility requirements. Not allowed. So as we go into the PPA restatement period, a lot of what will happen is with the safe harbor, if there are any tweaks you want to make to your document at the same time, for safe harbor plans, we'll want to do those 30 days in advance of the beginning of the year. We'll want to make the documents effective either January 1st of 2015 or January 1st of 2016. So just so you're aware of that. And then retention, we always recommend that plan documents be retained permanently. And I know that's a pain, and I would definitely do it with scanning and keeping them online. And the reason for that is if your plan is ever audited, the IRS or the DOL is going to want all of the copies of all of the plan documents and interim amendments back to when your last determination letter was issued. And again, this defies logic, but they're not issuing determination letters anymore. So I don't know if you need to go back throughout all of history or not, but my suggestion, and from personal experience, I would hang on to all copies of documents. Okay, enough about documents. Eligibility and compensation. I'm going to start with eligibility, and this is where we see, both of these areas are where we see compliance issues relatively frequently. So I want to give you a little background on eligibility provisions and then launch into what some of the common issues we run into are. First of all, the statutory maximums for eligibility are a minimum age of 21. You can't have anything higher than that. You can always have something less. For 401k employee contributions, you can't require more than a year of service. And for company contributions, match, profit sharing, whatever, you could actually have up to 2 years of service. Very few plans do that. If you do have 2 years of service, you have to fully vest everyone immediately. You can also exclude certain classes of employees, and these are statutory exclusions, so there's never an issue with excluding them. You can exclude union employees whose benefits were subject of collective bargaining. If for some reason you have union employees and your collective bargaining agreement expires and you're not able to renegotiate it, you've got an issue. You have to include those folks. Leased employees and the non-resident alien employees, which again, there are not very many of those in plans that we encounter. You can exclude other classes of employees, but if they're not the statutory 3 classes that we just mentioned, you have to be able to pass coverage testing, which we'll cover when we get to that section of the presentation. There are also entry dates. Once someone has satisfied the eligibility requirements, when do they enter the plan? And the law says they have to enter the earlier of 6 months after they meet the requirements or the first day of the next plan year. So historically, a lot of plans have had semi-annual entry dates. For example, if you have a calendar plan, January 1st and July 1st, because that's always going to comply with that rule. 401k plans have, over the years, tended to be more liberal. A lot of them will have first day of the month after they meet the requirements, quarterly, and some even have immediate entry. So the day that you meet the eligibility requirements, or even in some plans where they don't have eligibility requirements, the day you're hired, you're eligible for the plan. One thing to note about 401k is it's really difficult to have retroactive dates. You know, I've run into plans where entry date is the first day of the year that they become, that they meet the eligibility requirements. it's hard to retroactively do employee contributions through payroll deduction. So I would never encourage you to do retroactive entry into a 401k plan, just so you know. If you have that plan if you have that kind of a provision in your plan now, you may want to talk to your document provider about that. And then there are hours requirements. If you have a full year of service, or 2 years, anything over a year, you can require 1,000 hours for eligibility. That's the IRS's definition of full-time. Certainly not yours or mine. It's average of 20 hours a week, but that's the rule. If you're using a volume submitter pre-approved document as opposed to a prototype, you could actually put an hours requirement on a shorter period of service. You could say, for example, 250 hours in a 3-month period. I even have a couple of plans that are 1,000 hours in a 6-month period, but you always have to have the caveat in the document that says, in a 12-month period, if that person worked more than 1,000 hours, they're in. So even if they didn't get 1,000 hours in the 6-month period, if they got it in their first 12-month period, they're in the plan. You can never make anyone wait more than a 12-month period with 1,000 hours to be included. Most plans you count actual hours. There are a couple of other methods you can use if you have salaried employees or whatever. But even with salaried employees, most plans use actual hours and just guesstimate whether or not the salaried employees are working more than 20 hours a week. And then the job class exclusions, again, as I said, you can exclude any reasonable class of employees as long as coverage testing passes, which we will discuss a little bit later. But one thing that the IRS really frowns on is actually stating in your plan the term part-time. I'm excluding part-time employees. You can, to a certain extent, say seasonal employees or, a class of employees, maybe interns or something, but they really frown on you saying part-time employees for whatever reason. And also, if your company is part of a controlled group of companies, which means basically you have multiple companies that are owned by the same people, have common ownership, technically the IRS treats those as a single plan. Doesn't mean you can't exclude one of the companies. Again, if you can pass coverage testing, you can exclude one of those companies. So when we talk about coverage testing, we'll revisit that a little bit. One other quick note, if you're using a standardized prototype, you can only exclude the statutory union, non-resident aliens, leased employees. You can't exclude any other classes. So if you are using a standardized prototype, and if there's no fee difference with your vendor between standardized and non-standardized, I would always opt for non-standardized. It's much more flexible. Okay, let's talk about a couple of common eligibility issues. Both sides of this one. Not entering an employee when they first become eligible, and believe me, we run into this all the time. The remedy for this is, first of all, let me backtrack a little bit. In the old days, and again, I go back a ways in this business, in the old days, the threat from the IRS was, we're going to disqualify your plan. And they'll still threaten that, but in reality, they really won't. They'll bend over backwards to not have to disqualify your plan. And if a plan is disqualified, that means everything is taxable to the participants right away. All the deductions the company ever took for their contributions are disallowed, blah, blah, blah. I've never seen it happen. But what they've done in the last 10 years or so is establish correction programs that are approved by them, that if you follow the correction programs, you're not going to be disqualified. So anyway, the remedies that I'm citing in these slides are ones that come out of those correction programs. So if you don't enter an employee when they first become eligible, technically the way you correct that, and you can self-correct it without filing anything with the IRS, is you make what's called a QNAC, a qualified non-elective contribution, from the company in the amount of 50% of whatever that person's class of average deferral percentage was, plus lost earnings on the opportunity to contribute. Again, that's a really technical thing, and you'll want to talk to your TPA or your record keeper, whoever's doing your administration for you. But the key is that it's a company contribution. You can't just go back to the employee and say, oops, we forgot. Do you want us to double up? If it's only one payroll, whatever, and a person's not having problems with that, it might be all right. But the letter of the law, this is how you correct. If you enter an employee too soon, That's the other side of it. They didn't quite have their 3 months of service or whatever your eligibility requirement is, and you mistakenly put them in too early. Then basically what you're doing is returning the employee contributions to them, and it's taxable because if it came out of their check pre-tax. And employer contributions like match that were given to those folks can just be moved to the plan's forfeiture account. The other thing you could do is it's possible to do a corrective amendment to make that employee eligible. If they're a highly compensated employee, wouldn't do it. But if they're a rank and file, non-highly compensated employee, making an amendment that just says John Doe is, notwithstanding the other eligibility provisions, John Doe is eligible as of this date, is okay once in a while. Again, it's something you should discuss. Okay, next one. If you have an automatic enrollment provision in your plan, negative election kind of a thing where folks come in and they're automatically enrolled if they don't fill out an enrollment form, and you fail to timely automatically enroll them, or if your plan has automatic increases annually, you fail to automatically increase them, the remedy is similar to the one we just discussed for failing to enter an employee timely. It's a QNEC equal to 50% of the automatic enrollment percentage. There are a lot of record keepers now, the John Hancock Transamerica principles of the world that offer services where they will track that for you. They'll track automatic enrollment, they'll track automatic increase. So if you're struggling, if you have that kind of a plan and you're struggling to keep track of who's increased to what percentage when, you might want to check into some of those. Payroll providers may also be offering that. I'm not 100% sure. So those are eligibility fun things. Switching over to compensation. This is a slide I actually stole from training materials that our CPAs who audit retirement plans use. And I liked it because of the know thing on here. Again, reiterating, know your plan documents. Know what the definition of compensation is in your document. Know how it's defined for a participant in their first year of eligibility. Is it the whole year, or is it just from the date they became eligible that you're using for the first year? And know if there are any compensation elements that are excluded or included in your definition of compensation. I see a lot of issues related to these kinds of things, so knowing what your compensation definition is really important, and making sure that your payroll provider also understands it. Most plans will use either 415 safe harbor compensation, and I do hate that the IRS uses the term safe harbor for more things than just one. But generally what that is all federally taxable compensation plus deferrals added back in before tax deductions to tax qualified plans such as 403B, 401K, Section 125, cafeteria plans, those kinds of things. The other definition, the one that's most common, is W-2. And W-2 is basically box 1 compensation on the W-2, which means it excludes the salary deferrals that we just mentioned, but most plans will define it as W-2 plus the deferrals added back in. So it's basically gross compensation. There are things you can exclude, but it's basically gross compensation. The reason I say that is at the bottom of this slide, there's a discussion of the treatment of bonuses. And this is the thing from compensation perspective that I run into more than anything else. Unless the plan specifically excludes bonuses, and if it does, there's additional testing that we'll talk about a little bit later. Unless it specifically excludes bonuses, you should be withholding 401K deferrals at the standard percentage or dollar amount that the employee has elected, and you should also be matching on those contributions that are taken out of bonuses. Now, if you're not doing that, and it wouldn't surprise me, and it happens all the time, the plan can allow what's called a special bonus election, which says, if I'm going to do a bonus payroll, or if I'm going to give a bonus to this particular person, I can make them aware that they can fill out a special election to have nothing withheld from that bonus, or more than their standard percentage, or whatever. Up to you how you want to allow that. But if you're not going to withhold on bonuses, you need to get those elections on, folks. Okay? assuming that your definition of compensation includes bonuses. So again, that's a really common compliance issue related to compensation that I wanted to make sure that I pointed out to you guys. Okay. The first code word. Appropriately enough, since we just covered this, the first code word, jot this down if you know, for the survey at the end, is eligibility. Okay, getting back to compensation just a little bit. A couple of things about compensation. Accrued compensation, and this doesn't happen very often, but compensation that's paid maybe in the beginning of the following year but is really accrued back to the prior year, that is never counted for retirement plan purposes. Severance pay should never be counted either. And annual pay for plan purposes determined by the pay date, the date of the paycheck, not the period that the paycheck covers. And this happens at the beginning of the year. So again, let's say it's a calendar year plan. You're issuing a January 2nd paycheck, which probably covers the last 2 weeks in December of the prior year. That's a 2014 paycheck, even though it might cover 2013 hours. And the way I always tell people is think of it in terms of a W-2. That 1/2/14 paycheck is going to be on your 2014 W-2, not 2013. So that's the same rule that applies for retirement plan purposes. Okay, moving on to the next section. Timely contributions is a huge hot button for both the IRS and the DOL. It's something that has to be reported on Form 5500. It's something that they are just going to pounce on, and they always do. And the reason for that is if you're not timely submitting the contributions that you're withholding from people's pay, you as the employer have use of the employee's money, and that is considered a prohibited transaction. So submitting that money in right away, if the employee wasn't contributing, if you weren't withholding anything for their pay for the retirement plan, they'd get it on their paycheck. So basically, if you're not submitting it, it's not the employee's money anymore, it's the company's money. And again, historically, years and years ago, employers used to play that game all the time to manage their cash flow. Well, the IRS put the kibosh on that many, many years ago. It also applies to loan payments. Again, anything you're withholding from the employee's pay for retirement plan purposes should be timely deposited into the retirement plan. Common misperception, I don't run into it as much anymore as I used to, but I still run into it, is that you have until the 15th day of the month following the month that you withheld it to deposit it. That's never been true. The actual rule, as you see on the slide here, is as soon as the contribution can be reasonably segregated from the company's general assets, but no later than the 15th day of the following month. In reality, what they're really going to look at is, number one, how quickly do you submit payroll taxes? Number two, what's your historical practice been? How quickly have you been able to do it in the past? They came out 2 years ago with a safe harbor, again, the term safe harbor, for small plans, and I'll talk about what's a small plan versus a large plan when we get to the 5500 section. It's 7 business days after it's withheld. The date of the deposit governs. So if you're one of those folks that is mailing checks in, they have to be deposited within that 7 days for a small plan, or within the 2-3 days, whatever, for a larger plan. So there's some suggestions for what we can do with that I'll talk about again in a second. What happens if they're not timely deposited? Well, again, we have to report them on the Form 5500 as being late. May flag it with the Department of Labor if it's large amounts, if it's consistent year to year. I guarantee you will get a letter from the Department of Labor, might be a year later, that just says, oh, you had late deposits, have you corrected those? The correction is to calculate and deposit lost earnings from when they should have been deposited a day or two after the pay date or 7 days after the pay date to when they were actually deposited. And there's different methods for calculating those earnings. That's where you definitely want to get somebody involved from the TPA or record keeper perspective. You can self-correct that, but there is no formal closing of the issue with the DOL if you do that. Most plans do, especially if it's an aberrational thing and it's a small amount and it's, just one little thing or one person that didn't get a contribution. What the DOL would like you to do is file an application under the Voluntary Fiduciary Compliance Program. This is part of their correction programs. And then they will issue a closing letter that basically says a no action letter that you're fine. Unlike other VFCP applications, there's no fee or that you have to pay when you're submitting this, but you will have cost from the TPA or the attorney who's helping you with the application, and that can be pretty hefty. The application is relatively complex. I would always encourage you to do the VFCP method, but again, it's a facts and circumstances thing that you really should discuss with your plan advisors. Bottom line, don't have late deposits. A couple of best practices. Most record keepers now require that you submit contributions via ACH. You still have to upload some data or key in some data, or hopefully maybe your payroll provider does that. I would encourage you, if you're submitting the data, to submit it on the pay date or maybe even a day or two before when you get your payroll records. That way, when the ACH draw is done, it's going to be there timely. And also with daily valuation, where your participants can go online every day and look and see what's there, they see the money coming out of their check on Friday. If they don't see it going into their account online for a week or so, it's really noticeable to them. So just a couple of ideas there. And again, if sending a check, I actually would recommend that you send it via overnight mail unless you're just sending it across town so that it's deposited timely. Just a few comments on employer contributions. The deadline for employer contributions is the due date of your corporate return for that year with extensions. So for example, if you extended your corporate return for 2013, the due date of making your employer contributions is September 15th, which is Monday. So if you haven't funded your 2013 yet, you might want to get on that. You do not have to make your contributions by the end of the fiscal year, even if you are a cash basis taxpayer. And I've had that come up just recently twice with different clients, where they're being told that they have to make them by the end of the year if they're a cash basis taxpayer. No, that's not true. For retirement plan purposes, even if you're a cash basis taxpayer, you have up until the due date of your return, which basically says I have to make the contribution before I file the return if I want to deduct it on that return. So that's the rule for retirement plans. If you have a pension plan, basically a defined benefit plan, there aren't many money purchase plans anymore, there's a required contribution, and it has to be contributed within 8.5 months after the end of the plan year, which coincidentally is also September 15th. The timing of your deduction depends on whether or not you filed an extension, but even without an extension, it has to be made by 8.5 months after the end of the year. There's no hard and fast deadline for the timing of making employer contributions to profit sharing or 401k type plans other than the deduction deadline. I mean, if you didn't make it by September 15th, you can't deduct it on your 2013 return, but you could still contribute it. A couple of caveats there. If you don't make it within 30 days after the extended deadline, or in this case by October 15th, then that amount will count in the following year's limits. So if you have an owner, for example, that's maximizing, they're putting the full $52,000 into the plan every year between employee and employer contributions, and the contribution, the 2013 profit sharing contribution, isn't in by October 15th of 2014, that contribution is going to count against the 2014 limit for that person. In general, it's not a huge issue unless you have that situation where someone's trying to maximize. If you have safe harbor contributions, again, then those are relatively required contributions, so there are requirements for getting those in. Safe harbor non-elective, the 3% fix that goes to everyone, that has to be in by the end of the year following. Safe harbor match is the same way. If it's a year-end match, if you're matching with every payroll, then it has to be in by the end of the quarter after the quarter in which it should have been made. So just so you know, those are employer limits, and I get questions on those quite a bit, just so you're aware of those. Okay, we've moved on to the selection. Awesome. Testing is so much fun, let me tell you. And most people, they only think of testing as that ADP, ACP test, which is the test on the employee contribution portion, the one that has the dreaded refunds associated with it. But listed on here are all kinds of different tests that we as TPAs and you if you're involved in these or whatever, that we typically are performing on every plan. A couple of them are specific to certain plan provisions. But for the most part, we're performing all kinds of tests behind the scenes you may not be aware of until you get your package from us at the end of the year. So I'm going to basically talk about a couple of the big ones, ADP, ACP, minimum coverage testing, and top-heavy testing. But I'll mention the others just so you're aware of them and you're looking for them. So ADP stands for average deferral percentage. ACP stands for average contribution percentage. That's match. So you're testing for discrimination on deferrals and match. And deferrals, again, are employee contributions deferred from pay. Again, I've never understood. 401k rules first came out. The first time you had 401k plans was about 1984. I've never understood how you could structure a plan so that it would discriminate in terms of the employee's ability to elect to contribute. So I can only think that this test is just so that they're limiting tax advantages for highly compensated employees. Not sure, but anyway. The way you do this test is you divide the employees into two groups, and you guys are probably pretty familiar with this. Highly compensated employees, and those are anyone that owns more than 5% of the company, including people who are owners by attribution. That's basically the owner's spouse, their children, or their parents. There are very specific rules about attributing ownership. So you can't get out of being a highly compensated employee by moving all your ownership to your spouse, for example. And then the second category is employees who made more than the current limit right now is $115,000 in the prior year. So for 2014 testing, you're looking at employees who made more than $115,000 in 2013. Those are your highly compensated employees. Some companies, like, for example, a law firm or a medical practice or whatever, might have an awful lot of highly compensated employees and not that many non-highly compensated employees. There is a rule called the top 20% group rule. That's a plan provision that would have to be in your document. If you're a company that has that kind of situation, you may want to inquire whether or not whoever's doing your testing is using that rule. What that basically says is I can look at all the people that are 5% owners or make more than 115, and if it's more than 20, I only have to count the top 20% of that group of employees. May or may not help. We always look at, are the people that we're excluding under that rule not contributing at all, so there's zeros helping the average, but it's out there for companies like that. And then the second group that you're dividing into is your non-highly compensated employees, which is everybody else. And the way the test works is you're averaging averages. So you're averaging percentages. So you're not taking the total deferrals of all the highly compensated employees divided by the total compensation. You're taking each person's deferral percentage and averaging those percentages. Zeros count. So if you have highly compensated employees that aren't contributing, that really helps. It helps your highly compensated average be lower. On the other hand, if you have a lot of zeros in your non-highly compensated group, you may have testing issues. In general, the gap between the two averages, the average of the highly compensated versus the average of the non-highly compensated, can't be more than 2%. There are a couple methods that we use, and your TPA probably does as well, if we don't pass testing on the first pass, the most common one is called restructuring, where if your plan doesn't use the maximum statutory eligibility requirements of 21 in a year of service, we can exclude people who haven't met those statutory requirements yet from the testing. And most times those are non-highly compensated employees. They're newer employees who may not be contributing yet, and that usually will help the test. And then there are methods with current year and prior year testing. You're allowed to elect which of those you want to use. Do you want to do your testing based on last year's non-highly compensated average so you know what you're shooting at? or are you doing it in current year because you're having a big campaign to increase participation and you want to take advantage of that? There are rules about how often you can change back and forth, but that's another thing we can look at to see if we can pass. So what's the big deal? Here's the big deal. How do you correct a failed test? And it's your highly compensated employees that are usually affected, and they're not happy. This is where we get to refunds. There's two ways to correct a test, basically. One is refund money back to the highly compensated employees until their average is within that 2% spread. The second is make contributions for the non-highly compensated employees until their average comes up to within that 2% spread. Most plans do refunds. And there are all kinds of complicated ways for how those are calculated. But basically the things you need to know is if there are refunds, they have to be done within 2.5 months after the end of the plan year in general, which for a calendar plan would be by March 15th, which is why we harp on you to get completed census as quickly as possible after the end of the year so that we can do the testing on all of our plans and get the refunds done, if applicable, prior to March 15th. You can go past March 15th. If you do, there's a 10% excise tax to the employer on the amounts of the refunds. And really, the people used to proactively do that before the rules changed about the timing of taxation. I'll talk about that in a second, too. But in general, unless there's a real delay in getting the census or something like that in, there shouldn't be a reason that we need to go past March 15th anymore. And what changed here is the next bullet, which is it used to be that refunds were taxable to the employee, the highly compensated employee, in the year to which they came from. So you'd be calculating your refunds in March of 2014. It would be taxable to that person in 2013. If they'd already filed their taxes, they'd have to file an amended return. Thankfully, the IRS changed that rule a few years ago. It's taxable in the year it's received now, so it's not as ugly as it used to be. One of the tricks we can play with that, too, is if a highly compensated employee hasn't already contributed the maximum and they're over age 50, we can recharacterize the amount that might have been refunded to them as a catch-up contribution, and they wouldn't have a refund. So there are a couple things that we can play with there. If you have testing issues and your highly compensated folks are always getting refunds, I would encourage you, again, to talk to your plan advisors, your TPA, your record keeper, whoever's doing the testing, and talk about ways. Your investment advisor is usually another one that could help with this. Talk about ways that you can encourage participation or mitigate these kinds of things. And where safe harbor contributions come into play is avoiding the testing altogether if you add that kind of provision. Unfortunately, it kind of locks you into a company contribution, which is why a lot of plans don't use it. Again, the other way to correct testing, oops, sorry about that, is through what is adding, rather than refunding to the highs, add contributions to the non-highs. And those, again, are called QNECs, qualified non-elective contributions. Those are company contributions that are treated for every other purpose in the plan as employee contributions. So it's technically the company making additional employee contributions on behalf of the non-highly compensated employees to get their percentage up. I have one plan that does that because they never miss by a whole bunch, and they just, instead of making, say, a $50,000 profit sharing contribution, they make a $48,000 profit sharing contribution and a 2% QNEC, and they take care of everything without spending any more money than they ever were going to. So it always just depends on how much is your test failing by and what's the compensation of your employees, how many employees do you have, what's the cost going to be of that versus the refunds. Anyway, that's how that fun stuff works. The next test I wanted to talk about is coverage testing. Again, there's a separate webinar on all this testing, but coverage testing is an important one for a lot of reasons. We talked about the fact that you could exclude certain classes of employees. For example, interns, commission salesmen, I've seen those, whatever, that aren't statutory exclusions. Remember, union, leased, and non-resident aliens are the only statutory exclusions. You can exclude those other classes, but you have to be able to pass minimum coverage testing. And here's basically what minimum coverage testing is. Again, you're divided into two groups. You're highly compensated and you're non-highly compensated. And Each type of contribution, match, safe harbor, whatever, is tested separately for coverage. And you're basically looking at what's the percentage of your highly compensated employees that are quote-unquote benefiting under the plan, what's the percentage of your non-highly compensated employees. Benefiting basically means they're getting allocated a contribution. Okay? So if you're doing a profit-sharing contribution, you're testing minimum coverage on a profit-sharing contribution. You're looking at how many employees actually received one and how many highly compensated employees actually received one. And the percentage of the non-highly compensated employees benefiting must be at least 70% of the percentage of highly compensated employees benefiting. Let me give you a quick, simple example. Say you have a 4-employee plan, 1 owner, 3 non-highly compensated employees. The owner makes a profit-sharing contribution. Your plan has a requirement that people have to be employed on the last day of the year to share in it, and 1 of your 3 non-highs terminated during the year. Now you only have 2 out of 3 highly compensated employees benefiting. That's 67%. And you have 100% of your highly compensated employees, that owner, getting a contribution. You don't pass coverage. Okay? Small plans like that, I tend to not want to put in things like a last day requirement or a 1,000-hour requirement specifically for that reason. But that's where coverage comes into play. We had one just yesterday with one of our clients where they had this same issue, and what typically has to happen is that they have to bring some of those people back in and give them a contribution so they can pass coverage. So where this comes into play, plans that exclude, like we just said, for 1,000 hours or last day, plans that maybe cover one company of a controlled group and not the other. We talked about that in the beginning as well. Or plans that exclude, say, commission salesmen, one of the non-statutory classes of employees. You have to count those in your denominator when you're determining your coverage percentage, but they're not in your numerator. So again, the 2 out of 3 employees in the example I gave, or if you're excluding commission salesmen and more than 30% of your non-highly compensated employees are commission salesmen, you're not going to pass coverage. So how do you fix that one? Most plans have what's called the fail-safe method, and again, this has to be specified in the document, where they just bring in enough of the non-benefiting employees until 70% are covered. And there's usually rules about how they do that. Usually it's the folks that have worked the most hours that you bring back in. And if your document permits it, you can use what's called an average benefits test, which is a much more complex test. Again, I'm going into a lot of really complicated information. I'm doing it to make you aware more than anything else of questions you might want to ask. There's general non-discrimination testing that applies to profit-sharing plans that use what's called cross-tested or new comparability profit-sharing. That is extremely complex. I'm not going into that one in this short period of time. There's a minimum participation test that applies only to defined benefit pension plans, which most of you probably don't have. I wanted to spend a minute on the compensation discrimination testing because I mentioned that earlier when we were talking about compensation. Compensation, if you exclude, like I said, bonuses or overtime or commissions from your definition of compensation, that's a non-statutory exclusion, and you can do it. But again, you have to make sure that it's not discriminatory. For example, if you excluded overtime and that was it from compensation, the people who tend to get overtime are your lower paid people, not your highly compensated employees. They're usually salaried. So that is probably going to end up being discriminatory. You probably can't do it. On the other hand, if you exclude bonuses, those probably go in larger proportion to the highly compensated employees. And even if they go to everybody, highly compensated and non-highly compensated, as a percentage, you know, what's my compensation without bonus as a percentage of my total compensation, you might still be fine. But what I want to point out here is this testing doesn't always get looked at. Sometimes we take over a plan that has an exclusion like that, and we're asking for that testing, and it hasn't been done. So again, something to be aware of, something to ask your provider about if you have that provision in your plan where you're excluding something like that. Okay, we've come to code word number 2, appropriately enough, testing. So code word number 1, eligibility, code word number 2, testing. Jot those down for later in the survey. Thank you very much. Okay, a few more things on testing. The other big one I want to talk about is top-heavy testing, because that comes into play all the time too, and people are not happy when they find out their plan's top-heavy and they didn't expect it. Top-heavy, again, one of the things I'm fond of saying is never try to interject logic into IRS regulations, and I'm sure there is somewhere in there, but for whatever reason, when they came up with the top-heavy rules in I can't remember when that was, but anyway, when they came up with the top-heavy rules, rather than using the highly compensated, non-highly compensated definitions that they use for everything else, they went to these key employee definitions, which aren't exactly the same. Similar, but not exactly the same. There's no straight compensation test for key employees. You have to be an officer earning or a minority owner earning more than a certain dollar amount to be key. And what basically is you look at your account balances at the end of the year. If more than 60% of the account balances are going to key employees, you have a top-heavy plan. If you have a top-heavy plan, so what? You have to make a minimum contribution of at least 3% to each of your non-key employees. So if you're not expecting that and you weren't planning on making a contribution, you've got issues. How do you get around that? I'm going to skip ahead a few slides here for the sake of time. If your key employees aren't contributing at all, which probably is not happening, then you don't have to make a contribution. The minimum contribution is actually the lesser of the highest percentage any key employee contributes, or 3%. So if no key employees are contributing, you're fine. Employee contributions, 401k deferrals, those count in terms of determining that percentage. If you have a safe harbor plan, not only do you get out of your ADP, ACP testing, but you're deemed to satisfy top-heavy testing. Right off the top, if you're using the 3% fixed safe harbor contribution, if you're using safe harbor match, and this is a relatively recent rule, and you don't make any other company contributions to employees in that year, just the safe harbor match, then you're deemed to also meet the top-heavy minimum rules, even though the people that aren't deferring aren't getting anything. So things to be aware of again. A couple other real quick things on testing. There's an annual additions limit on how much one individual can get allocated across all types of contributions. Employee deferrals, match, safe harbor, profit sharing, forfeiture allocations, all of that. Currently, that's $52,000 a year. Typically, that will only happen with the owners, the highly paid people, but it could be an issue. If you exceed that limit, you have to refund. There is a company deduction limit on just employer contributions, not the employee deferrals, that basically in a 401k plan is 25% of the total compensation of all the eligible employees. And there's what's called a 402G limit, which is an individual participant limit on how much they can defer out of their pay into a 401k plan. And that currently this year is $17,500. If you're fortunate enough to be age 50 or older, and in my business that's a good thing, you can contribute an additional $5,500, so a total of $23,000 for 2014. Again, if you exceed that limit, you have to refund it, and the deadline for refunding these is the April 15th following the year in which they occur. Most payroll systems can accommodate a limit on this, but if you don't have a calendar year plan, if you have a fiscal year plan where, say, your plan year end is September, you've got to watch it on a calendar year basis, or your provider has to watch it on a calendar year basis. You technically have more than $17,500 in a calendar, in a plan year, if you don't have a calendar year plan year. But you have to then look at how much did they put in from 10/1 of last year to 12/31 of last year, and how much did they put in this calendar year, 1/1 to 9/30, in your 9/30 fiscal year, to see whether they've exceeded the 402G limit. And again, refunds. Refunds, refunds, refunds. There's also a maximum compensation that can be counted. This year it's $260,000. Common payroll error we're running into all the time is either they're not properly capping the match, and you're making match with every payroll. Someone, if you, in this example here, if your match formula, the highest match anyone can get is 3%, Well, then the highest match any highly paid person gets is 3% of $260,000 or $7,800. If the payroll system keeps calculating match every payroll when the person has made well over $260,000, their match might exceed $7,800. On the reverse side of that, and I've just seen this recently in 2 different cases, the payroll system stops their match when they hit 260 in cumulative comp. That's not correct either. As long as their match hasn't exceeded the maximum, they can still get match. So again, things to think about, things to talk to your payroll provider about. Okay, up to the final section. I say I have 10 minutes left, so I don't think we're going to have much time for questions and answers, but I haven't really gotten any. Reporting and disclosure. There's all kinds of things that need to be handed out to participants. And when they passed one of the big pieces of legislation several years ago, a lot of us in the business refer to it as the Participant Notice Act. It's not enough that you have to give them a safe harbor notice. Now you have to give them one for qualified default investments, fee disclosures, automatic enrollment, 404C, all kinds of fun stuff out there. And I don't know about you, but I think most employees throw it in the garbage and don't even look at it, or they might glance at it and don't understand it or whatever. The first couple of slides here just give you all the various disclosures and the time frames for them. I've gotten a lot of questions recently because it's 5500 season on when does a summary annual report and SAR have to be handed out. That one is the last one on this slide, within 9 months after the end of the plan year, or if later, 2 months after the extended due date. So if your 5500 is on extension, 2 months after October 15th or by December 15th of this year. The fee disclosures, by the way, when that first came out in 2012, the deadline was August 31st of 2012. Those all had to go out. Last year, they recognized that it's a pain for employers to have all those different deadlines for handing out things to participants. So they allowed you to make a one-time change. You can't change back, to dovetail that with your other notices, which usually are due within 30 days before the beginning of the next year. So instead of giving out your fee disclosures by August 31st, you can combine them with your other notices and give them out by December 1st, for example. So, you know, if we're your TPA, let us know, and we'll flag that so that we're dovetailing all that together for you. All right, I want to spend a little bit of time on 5500s, and that will be about it. The thing I run into more than anything on 5500s is the small plan versus large plan. And if you are a quote-unquote large plan, that's a government definition, it's in the instructions for the 5500, you are subject to an audit by an independent CPA every year on your plan, and those can cost anywhere from $5,000 to $15,000. So most employers would like to avoid audits. If you are a really large company, you're never going to avoid that audit. But if you're on the borderline, there are things you can do to mitigate it. Okay. In determining participant counts, and this is one I'm constantly explaining to employers, advisors, even sometimes to the auditors, although they're pretty good at it now. Determine whether or not you're a large plan. You look at your participant count as of the first day of the plan year. So for 2014, you're looking at it as of January 1st, 2014. You start with the ending number on your 2013 5500, and you add in any new employees who were eligible on January 1st of 2014. So not the people that became eligible April 1st or July 1st, but only the ones that were eligible on that first day of the plan year. Okay? Who are you counting? This is where people get confused. All currently employed people who are eligible for the plan, whether or not they're contributing, whether or not they have a balance. If they're eligible, they're counted. And all terminated employees who still have their balances in the plan. That's the ugly one. One of the things that we would suggest, strategies to avoid large plan status, pay out your terminated employees as quickly as you can. If they have more than $5,000 coming, you can't force them out of the plan. You certainly can encourage them, send them forms, whatever. If they have less than $5,000, you can force them out of the plan. You send them forms, you give them 30 to 45 days to respond. If they don't, then you can force them to an IRA outside of the plan. And most of the record keepers have IRA alternatives for that. That has to be in your plan, that provision. If it is, you want to proactively manage that. And again, work with your TPA, work with your record keeper to do that. Need to get them out by the end of the year so it doesn't affect your 1/1 count for the next year. You can also consider changing your eligibility requirements. That can only be done prospectively, and it won't help you in terms of folks that are already eligible. But I ran into one recently with a client of mine where they had pretty much immediate eligibility, and they had a lot of coming and going. So what we decided to do was, going forward, let's put in a 3-month or a 6-month, whatever, eligibility requirement so that we stop the bleeding. We don't have as many new people coming in so often that if they're coming and going quickly, probably aren't contributing, and they're causing all kinds of issues to the large plan thing. And the other thing that we've done a few of, and the IRS, for whatever reason, blesses this, they don't have an issue with it, is splitting the plan into 2. Okay? And if you have different locations, that sometimes can be how you do it, or different job classes or whatever. But split the plan into 2. Neither one is more than 100 participants. Maybe we're okay then. One client I met with recently said, well, the rate we're growing, even if we split it in 2, one or both of them may be over 100 in the next few years, and then we've got 2 audits, so we decided not to. But if you're just borderline over 100, you may want to think about doing something like that. And by the way, one thing I didn't mention that's not on the slides, there is this little grace period rule that they give you, not in the first year of the plan. If you're over 100 as of the first day of the first year of your plan, you're stuck. You're going to be subject to audit. But if you've been under and you're filing a small plan, 5,500, you don't have to start out with an audit as a large plan until you go over 120 eligible employees, not 100. So you have a little bit more wiggle room there. The January 1st that you have 121 in your count, then you're stuck. So just so you know, there's a little more wiggle room there. Filing deadline for the 5,500 is 7 months after the end of the year, July 31st for calendar year plans. You can extend it up to 2.5 months. That's pretty much a rubber stamp. And for terminated plans, the month that the assets are distributed is the month that governs when the final 5,500 is due. So if all of your assets were distributed on September 3rd, September 30th is your deadline. 7 months from that is April 30th of 2015. That's when you'd have to file your 5,500. And finally, if you're filing late, consider using the Department of Labor's CFVC program. It's much easier than that VCP application we talked about for late contributions. And it has a penalty associated with it, but a much smaller penalty than what you would get if the IRS or the DOL discovers the late filing and assesses their own penalty. So that pretty much wraps up everything I was talking about. There is one more code word, and as you might guess, it is Form 5500. That's actually 2 words, kind of, a word and a number. So you have eligibility, you have testing, and you have Form 5500 as your code words for the survey. I know I covered an awful lot of stuff. I know it's complex stuff. My goal today was give you some things to think about, to be aware of, to look into. There are resources out there for looking at this stuff more often. I usually start with the bottom one here, Google. It's faster. But the top 2, the IRS website, is a plethora of information, all kinds of stuff. How do I correct mistakes? What are different features of different types of plans? And then, not to be underplayed, the second to the last one there, your friendly Sikich Retirement Plan Services staff. Even if we're not your TPA, call us, email us, whatever. I've got contact information on the next slide. We're happy to help. Okay, I do not see any questions in here. So either I totally boggled your minds, or you have no questions. But if you do, after the fact, whatever, again, just call or email. We're happy to help you. Again, you can see my contact information up there on the slide that I have up now, my email address and my phone number. And this is your friendly Sikich Retirement Plan Services staff on the TPA side of the world. So I thank all of you. Don't forget the survey. Again, copies of slides and everything else will be coming out. And enjoy the rest of your day. Thanks very much.